Hello and a very warm welcome to everyone. Today we are going to talk about an asset class which is the new hot thing on the Wall Street. It is the private credit space. Rising rates and widening spreads have lifted private credit returns to about 12%. In fact, some experts are also comparing the resulting 14 to 15% gross IRR comparing with an 18% mean net return for buyout funds in the vintage 2008 to 13. So first, really, let's understand what really is private credit, the new superstar in the private capital space. Now, private credit is a form of lending outside of the traditional banking system in which lenders work directly with borrowers to negotiate and originate privately held loans that are not traded in public markets. Now, what really has been the phenomenon back home in India? Back home in India, private credit has a good run. Private credit activity in India continues to witness a strong growth momentum. In fact, a latest EY report actually said that during the first half of 2023, about $4 billion have actually been deployed across this asset class. While we are on the subject of private credit, which is characterized by investing in more mature spaces like real estate, allied infrastructure, manufacturing, and so on, we also have a debt solution for startups. Popularly known as venture debt, it essentially aims at fulfilling the capital requirements of the startup without having to fork out or dole out a lot of equity. And to talk more of this with me are two people who dabble in the world of private market as part of the daily profession. Please help me welcome Sonal from Desai, Diwanji, and Chetan from Anicut Capital. First up, I think, Chetan, it's very important to understand from you, taking it further from my opening remarks, this new superstar in the private market space, which is private debt. What really has really been the two or three key factors which have led to the ballooning of this space? Is it the rising interest rates, you think, which really has led to the growth of this space tremendously? Or do you think the banks have kind of pulled out from traditional lending to catering to these kind of lenders, and which is why we're seeing sort of this kind of huge sort of momentum in this space? Yes, Chetan.
Yeah, thank you. Shrija, for this opportunity. See, private credit space operate, differently, slightly differently in terms of what they cater to. Majorly, it can be a special situation, it can be a growth capital, it can be a last mile funding, or it can be a mezz debt. Across various category of some of these products that I mentioned, banks have kind of stayed away from some of this transaction, not only because of the regulatory constraint but also because of the nature of the transaction itself. I'll just quickly take you through in terms of where the startups are feeling the pinch. So some of the startup are generally started by the first generation entrepreneur. They have their own ups and downs in the business, and banks operate at a extremely regulated way of their offerings. Like, you have your drawing power, which has to be backed by your receivables and the inventory. In some of the startups, you may not have this kind of real kind of MISs which can give you this kind of offerings. So what is happening is, when bankers are unable to understand some of these startups, that's when the funding gap comes in, which are kind of getting fulfilled by some of these venture debt guys. I'll give you one more example of some of this venture debt or private credit space where we work on. Uh, uh, a bank may require a hard collateral as well for a funding of say 10 crore, 15 crore, 20 crore kind of opportunity. A startup promoter may not be able to offer, so his growth becomes limited. A venture debt guy, private credit guy comes in and offers him 5 crore, 10 crore facility with whatever available in terms of current assets or fixed assets or some cash collateral, escrow of the receivables, and they take that risk, and they offer that facility. And yes, it's slightly expensive, but given the opportunity that the promoter is seeing in the growth phase, he will pick it up from a venture debt guy. There are few negative things as well, which we can again discuss once we discuss on the challenges.
Thanks for that, Chetan. I think one understands that what really could be the motivations from a startup founder perspective to sort of go to venture debt vis-a-vis equity. You said that you don't really have to dilute a lot of equity, and perhaps some of these founders might not have a large collateral to go to a bank against which they can take the money. But I also want to understand from you that why are maturer companies in the space of, say, real estate or infrastructure, are opting for private credit then? And the second point, also being from the startup founder perspective, is that is it really dumb money then? Because when a startup founder goes in terms of raising equity, you're looking at operational expertise, you're looking at equity plus some smart input. So venture capital has traditionally been called smart money, right? So are we saying that, I mean, ultimately the color of the money is green, right? To take it from debt or equity. If I'm a startup founder and I'm going to Anicut Capital, what is it that am I getting? If I go to a classic VC fund, at least I'm getting operational expertise, I'm getting a huge access to their network, and also perhaps a brand name on my cap table. From a startup founder, why would I go to Naniket Capital if the color of the money is green, really? I just want to understand that. Yes.
Yeah, I will pick up on why a real estate company comes to a fund like a private credit fund. So as I mentioned you, there are a few opportunities which a real estate company look at. Like I'm starting with the acquisition of the land. Acquisition of land is a basic necessity for any real estate player. In today's RBI regulation, funding for an acquisition is any bank cannot fund for that purpose. Funding for acquisition of the land is kind of banned in this country, but there is a huge requirement for that. Now somebody has to come in and play a role in terms of funding that. So, earlier we had some flexible rules across NBFCs who were funding it. But as we talk, regulations have tightened for acquisition of land, and this gap is getting fulfilled by the private credit space. If you just recollect maybe 15 years, 20 years back when, as an end use, this was available. However, for that last minute funding, if I need some 2 crore, 3 crore, 5 crore at a last minute for my project, it was not available from the bank. So we generally, companies, corporates used to approach a local Bania, local Marwadi, local Sindhi for that last mile funding. Now, if you just see, things are getting organized in the last, say, 5 years, 10 years. So some of these business are becoming organized, firstly, the funding. And what is also happening is, a lot of regulatory constraints are coming up because of, your IBC 2016, which is one of the big, regulation that has happened. Your GST implementation, your income tax new regulations that are coming, which is making the more and more economy organized. So some of this last minute funding also are coming to people who are organizing some of this requirement, which is morely private credit. Now, who are the participants in the private credit? The one of the major participant is your HNIs, your family offices. Now, what has happened in the last, say, 5 7 years, there is huge wealth that has been created in the market, and they find, instead of routing it through, say, a mutual fund, or as a part of fixed income, placing it as an FD, not offering returns that they are expecting. And this private credit space, since it is becoming more organized, SEBI is coming up with proper regulations, updating it itself. It is becoming a safe place for them to route it through fund like us, which are kind of regulated by SEBI. So, given this contract, this thing happening, a real estate company will come to us for borrowing this requirement. Yes, I'm again reiterating, we might be slightly expensive, but, it is solving the purpose of of the company, which is not getting solved. Point number one on real estate. Point number two on startup. As I mentioned in my initial introduction, some of the startup companies are in a trajectory depending on their life cycle, be it first 3 years of the trajectory or 3 to 5 years of the trajectory. there is always a capital required at various stage. It can be for your working capital, it can be for your paying to your payables, it can be for you found a good property where you want to move your office, but you don't have capital for that. Any small requirement keeps coming in, or the requirement can be for, they have found a new partner whom they want to acquire, or in the later part of the stage, a private equity who has invested in that company wants to exit that firm, and a promoter feels that he can buy that out. So some of these opportunities are there in the market, which few are banks and NBFCs are catering to, but many of them are, they are not able to cater. And private credit space, because we understand the space very well, we bring a lot of expertise in terms of firstly understand the requirement, and staying with the promoter during the ups and downs, like a private equity player, we also do the similar stuff. uh, so we bring a lot of value addition. As you mentioned, we not only bring our own expertise in the structuring of the transaction in terms of the repayment, we also bring our own ecosystem in terms of uh, you know players around us. It can be a private equity player, it can be a HNI who might be interested in directly investing in the company, uh, 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 and we also bring a lot of expertise, connects. See, we have around 100 odd portfolio companies across various businesses, so the connect also we provide them. So some of this value addition that we keep bringing to a startup promoter, that's why majorly they like us. And we don't look at from a lender's perspective, I would put this way. We are an investor, so we are a partner who sit with them, who sleep with them, who kind of spend a lot of time with some of these guys, and we do a lot of stuff beyond only a proper lender like an NBFC or a bank.
But sort of tell me one thing, and I want to understand. So you're basically, you will support the VC fund, right? You can't be the only investor on the cap table, right? It's basically a complementary or supplementary role at best, right? One can say that.
No. So okay, we are a debt partner again. We are always in the on the liability side. As a once you have taken a debt, you will have to repay us over a period of 3 to 4 years kind of period. But when an equity, once the money is coming in, the exit is always a secondary. Either it can be a next series or it can be an IPO. But in debt, generally, it has to come from your cash flows.
Mm.
So your question is, that whether we will stay put with the company for like 3 years. My answer is yes. Okay, in 3 years of time, the company can grow with the help of the debt that we offer. See, we have seen companies which have 2x 3x revenue with our money coming in. See, we come here, solve the problem and stay put. Okay, and the moment your problem is kind of dissolving, we just see if there are cash flows are available to repay us. So that conversation we keep having with the promoter. Though yes, most of the term sheet that we agree upfront in terms of the cash flows. But yes, wherever possible, we support them in terms of bringing one more player into a cap table. Or maybe at times what we also do is, as my debt is expensive, once the things get settled, we also bring in our own ecosystem. Could be a bank or it could be an NBFC whom they can refinance us. We are happy to look at that way also. See, ultimately, what we want is, the founder, the promoter of the firm has to, at any situation, he has to be growing. He has to be the winner, and we are just an enabler for, for him.
Thanks for that, Chetan. I like the way you have been saying our debt is expensive. We are there for the long term. So you've been very honest in admitting that they are expensive. I come to you now, Sonal. And whilst we were talking, you also sort of mentioned that, Shrija, you look at the larger ambit of the private equity space. You look at equity as well as debt. So, in terms of the contracts or the agreements, how do they differ vis-a-vis one who is bringing in equity on the cap table and one who's bringing in debt? In terms of structuring of transactions, what are the trends that you are seeing? Are you seeing increased preference from startup founders to opt for debt versus equity? What really is the conversation like? Give us some sense.
So I think one one concept that we all need to understand about private debt or venture debt is that you can't compare it to equity. It's not a substitute for equity. It's an option available for founders, for emerging companies, for raising funds. Having said that, the investment thesis of a venture debt or a private debt is different than a venture equity. Typically, you can't treat this as a term loan or a working capital facility that you would take from any bank or a financial institution. They do come with, the philosophy is a mix of both, Shrija. It's actually a predictable interest income, and sometimes it comes with an equity kicker, which is especially more like warrants or options, where the venture debt company or the private debt company would also kind of have an opportunity to earn superior returns. And we've seen that. We've seen a great interest. We've seen in the past 18 months, in the first half of the financial year, renowned names coming up with first and second private credit funds. There are plans of, put forth by Nippon Life Insurance. There is Anicut, who've come up with their second, I'm assuming, venture-led fund, etc. So there are a lot of announcements and plans. So clearly, it's a preferred option. From a documentation perspective, it would be a combination of any debt, financing, or debt come mezzanine financing, which is backed by a warrant or an option.
Okay.
So change there, but yes, it's a little less. I wouldn't say less collateralized, but it's a little different. The collateral here is not from a traditional collateral that we see in any debt financing. So if you look at the startup fund, most of the startups are not asset heavy. So what would be the collateral that a venture debt fund would be looking at? So it's hypothecation, it's brand equity, it's IPR. So it depends on each company's strengths as are evaluated by the lenders. From a founder perspective, Shrija, I think a venture debt or a private debt is a great viable option as when it comes to equity financing, because obviously there is a comfort of no equity dilution. There's a comfort of maintaining control ownership. A founder does not have to hastily agree to lower valuation. When he's negotiating with the venture debt or a private debt guy, there is a lot of scope and flexibility to restructure the payment terms, the coupon interest as per the business cash flows. And your venture debt, like Chetan rightly said, they would be more pro towards the business flow and changing the terms accordingly. So there's a lot of flexibility. Secondly, these are very quick process as compared to any bank, because the fund structure is pretty flat. It's less bureaucratic hassles. So it's quick money in that sense from a founder perspective. From a documentation perspective, obviously, like I said, these are more like mezzanine financing. There are very
also quicker. Yeah.
Yeah. And there are also
quickie and
correct. Yes, and that kind of helps. Now, what we are also seeing is that like human mind can get as creative as it can, right? So within that space, we've seen various structures. We've also seen reward-based financing, where they're linking the financing to certain returns from the business flow for a predetermined amount, and then they can probably decide later. There is simple vanilla financing backed by IRR-related, equity kickers, and the IRR is flexible. The venture debt lenders has the option to convert at a time where the IRR rate is good for him. So there are various structures that are given. But having said all this, Shrija, one should realize, and especially the startup founders need to realize, that venture debt is not everyone's cup of tea. It has to be evaluated. When does the startup or the founder want to avail this kind of financing? Because there are certain catch to that financing. There will be a higher rate of interest. The founder, before availing this financing, needs to ensure that the company is strong enough. It has a great steady flow of income. The current asset pool is strong. It has a great equity capital pool, existing funds. Because the venture debt or the lender, private credit lender, would also be looking at these aspects.
Absolutely.
So they are going to secure their loan. So, and we've seen cautionary tales in the market. We've seen, Baiju's debt scenario. We've seen PharmEasy and Thyrocare's acquisition, where the founders, and the promoters found themselves in some trying times while renegotiating and restructuring the debt. Lenders have come back with prepayment conditions and very high interest rate. So, one needs to kind of assess, and obviously, with fund managers and, investment credit funds like Anicut, who are there to rightly advise at what stage this avenue of financing needs to be availed. So it's a combination of both. And I think from a documentation, I've said what we've been seeing, but it's also a mix of, like he said, I would put venture debt or private debt in a mix, a mezzanine debt of equity and debt, where there's a lot of I think the debt fund at that point in time plays a bigger role than just a lender. It kind of helps, and venture debt, like Chetan has enumerated, has been taken for various reasons, for M&As, future working capital facilities, etc. So I think that's the view that a company and a lender should be looking at when they do decide to take the step for availing this kind of debt.
That's well put, and I'm not really sure if this kind of insight is really available. I'm not really sure if founders really have the ability to sort of really distill the difference on when to go to a venture debt. Are they really the correct people to take venture debt at that stage in their life cycle where they are? And the unraveling of some of these bigger startups, especially on the debt side, have had huge lessons to be learned, especially for the founders. And I do sort of appreciate the candidness of Chetan in the very beginning, where he's repeatedly said that we are expensive capital, and that there is some bit of understanding and education needed on the part of startup founders to understand when they're getting in bed with the venture debt fund. What really are the confrontation points, Chetan, if any, with startup founder, the difficult conversations, the ugly conversations that come to the fore? We've spoken about the good part, but let's talk about the ugly part also here.
So, okay, good. I will just add on from Sonal. So what is happening is some of the founders whom we interact, or some of the company CFOs whom we interact, they consider the private credit in sync with your NBFC or a banking credit. Okay, so it takes a lot of time for us to tell them, thus the money that you are looking is more of private credit space. It's not like a banking requirement or an NBFC requirement where you have some asset backed collateral is available for somebody like a company. Here it's slightly higher risk. Okay, and you'll have to bear with us in terms of taking you through why it is slightly riskier credit. So that conversation, founder for founders, their company is the best company, their product is the best product, and their ask is the best in the world. Okay, so they swing over there, and we have to try kind of bring them back, because we understand where your requirement is. We feel that probably a private credit space may not be the right kind of option for you. There are many situations where founders want equity to be substituted by the debt, which just Sonal said. We need to understand that we need to educate the founder. Certain odd times you need an equity rather than a debt. I can give you a classic example. A company is a negative net worth company, want to raise a capital after a period of say 1 year hence, wants to bridge the year's working capital which a venture debt. Okay, now this kind of problem, a founder has to realize it's a negative net worth company, and you're already burning cash. If you put further debt as a liability, as a repayment based liability, then you have a bigger issue. So one need to think through when he has to pick up the debt, what cost it is, how it is going to work around in his old transition. Yes, maybe if the cash flows are good, and if we see some light where the transitioning is happening from a low cash flow to a higher cash flow, we could take certain bets. But if we feel the companies are not or will eventually will have a lower margin, leading to a lower EBITDA, leading to a lower cash flows, then we say no. Just to tell you the number, I reject maybe 25 30 cases out of 25 cases out of 30 cases. So which means I look at, as a filtering mechanism, I only look at 5 cases out of 30. And I also have a strong underwriting team which may be rejecting another 2 3. So because and a lot of bloodbath is happening in the market in current circumstances. I mean, I'm sure everybody are reading newspapers. A lot of bloodbath is happening. So we have to be extremely crucial in terms of offering the right kind of credit to the right kind of people. So that's what it is. I mean, I have just given an example also what's happening in the industry. It's pretty tough. I feel sorry for some of the founders as well, because suddenly, from a market share perspective to they become more profitable perspective. Now that momentum has shifted in the last 1.5 year. The person who was driving for market share, now we are asking him to pump profit. And it's a very difficult change in stance taken by many companies. But yes, one good thing that is happening is, people, founders, the private equity investors are aware of this private credit space which is available. So they keep reaching out to us in terms of, whether this is the right fit for the company. Awareness is available there. Maybe in few cases, that awareness across the founder, we have to just bring it onto the table. But I would say maybe 70-80% of the companies are aware what we are doing and how we are doing, how we look at credit, from credit. So this is what it is. I keep rejecting at least 1 or 2 transactions a day.
Feel that, and I do feel that a lot of education and awareness is important so that they just don't get rejected at the very first stage, and your
Right.
life would become so much easier. Sonal, I
Right.
think that's good to sort of get you in also at this point of time. Let's define the right kind of company. To give us the characteristics of what will make for a right company to opt for a venture debt. Scenario one, I'm a deep tech company. I feel that my IP is the best, but I have no line in sight to make money for the next 5 years, right? I do have a great VC on the board asking for a large amount of equity, but I have cash burn sort of every month, which is humongous. And I'm not thinking of balancing my cap table, getting a debt partner. Am I the right person to get a debt partner at that stage in the third year of my startup? What do you think?
I think Chetan would be the right person to check the balance sheet of the company. But like what I would like to say is that like every mother loves her child and her child is the best amongst the rest. The same kind of phenomenon is a bit applicable to the founders. So I think primarily, I think there has to be self-awareness of the founder to understand where the company stands. There are funds and the fund managers who are right there to advise. But one thing that I've seen, and from my discussion with certain industry players, with certain funds and certain founders who, in today's winter funding situation, that is happening with the whole ecosystem, startup ecosystem, one thing that the person needs to be aware of, that it's not just about what projections your business is going to make. What the debt funds literally look at is the potential of the business, the revenue stream, and it has to be a steady revenue stream, the existing assets which are back of the company, the equity pool of that company, and the current capital assets. It has to be a healthy one. And if I were a fund and if I'm saying that this company is not bootstrapped, is facing a lot of losses, I would imagine that it's not a very appetizing offer for any debt fund to consider it. Maybe then they may have to succumb to a lower valuation, get some equity funding in there. Or because then with that kind of math that you just shared, Shrija, the company may not be able to service the high interest debt which most of the funds offer. So like Chetan started off at the right note, that there has to be a realization that venture debt and private credit is expensive debt. So
It's
you need
expensive.
to...
Yeah, and also he sort of reiterated quite a few times that the focus has to be on the cash flow.
Absolutely. And obviously the asset pool of the company.
Yes.
So like I said, again, it's not a substitution for equity.
Yes.
So,
Yeah.
so the founder needs to be really aware. Obviously, I'm going to let the math and the Excel be handled by Chetan, because I'm a lawyer and numbers like are not my game. But should be the self-awareness that I think a lot of founders and even emerging companies, not just startups, there are a lot of emerging companies who are in funding, should be aware of.
Yeah, because I don't really think that this kind of education inside is sort of very readily available. We spoke.
Sorry to interrupt. I think, but the dialogue has started. We have a lot of funds. We have a lot of fund managers who have been having this conversation, and it's very insightful that Chetan has kind of put in the numbers of the proposals that they have rejected.
True.
And this is purely a result of the dialogue that he's been having with the founders, with the promoters. And I think that should be taken in a positive way, not like, oh, I can get another fund to raise money.
I will, Sonal, I will add that maybe later on the conversation. Yeah, sorry to interrupt.
Yeah, but I think that's what is very important, even to take it in a positive manner. Because I think a dialogue on this debt funding, because we all love to hear the term venture debt and the next star and the traction and all. But I think it's very important to be aware of what it brings with it.
No, definitely. The risks and the rewards have to be known. Because what really is happening in the Indian startup ecosystem, whom we imagine too big to fail, has already begun to happen. And that combined with the fact that startups really in this country have no line in sight of profitability, quite a few of them. And I think a lot of it also has to be the VC phenomenon, where VCs themselves sort of fuel this perception that, okay, if you have to be the number one or the number two in the category, and that requires a lot of cash burn, we are there for you. Just because the funding winter has arrived, the markets have changed. Now frugality is the star. So these dialogues will keep changing. VCs will keep changing their stance for the startup ecosystem. But the poor person really is the startup founder. He or she really is left alone in this entire sort of gyrations of the VC and the sort of the startup funding environment that keeps unraveling. We spoke quite a bit from a founder's perspective in terms of the education, the insight, the awareness that needs to happen, the mechanics of venture debt, how does the math really work, and the very fact that about 80 to 85% of proposals are getting rejected on a daily basis, and further at the screening level just goes on to show how much of education is still warranted in the ecosystem. Let's talk about the asset class itself. 2023 as a vintage for venture debt. Definitely a great vintage for venture capital, because one sees some of very good companies also coming in, and some historically the best companies have come in the downturns. But if you look at from an LP perspective, the returns of venture capital compared to venture debt, something must be going in the right direction, where fund after fund, venture debt funds are getting flowed, right? So yes, Sonal and Chetan, so I'll come to you, Chetan, first, and get Sonal's perspective on this one.
Okay, the question is why the funds are flowing into private credit space. That's the question.
The returns. So how do you compare the returns vis-a-vis the VC fund and venture debt? Yeah.
Okay. Now, I will just give you some 2-3 instances what is happening, probably to set a context why the money is flowing here. One larger context which I have told upfront is, many family offices, HNIs are becoming more and more organized. When I'm saying organized, they are offering, they are creating a family office setup. They are professionalizing their investment, as well as what is happening is some of the large family who had 100% of commitment into their own company, they also wants to diversify themselves in terms of probably 5% into a VC or a private credit space. Okay, so that is point number one. And in the last, say, 10 years, many family officers, many individuals have made huge wealth. So the wealth is just started. We are just at the tip of the iceberg in terms of wealth creation for the country. You will find many people will make huge wealth in the next 20-25 years. So which is leading, a lot of liquidity is available at a family office HNI level. So where will they invest? So they do invest in through mutual fund. They do invest through your maybe a little bit in the fixed income in the form of FDs. They invest in VC, as well as they invest now recently in the performing credit space. Now, what is also happening in the mutual fund industry for the fixed income, there was a tax arbitrage that these guys had a benefit. Now, that tax arbitrage has now gone, which means a mutual fund will offer them a return of, say, I'm just between say 6% to 8% is the return that they would get. So people don't want to invest in a mutual fund for the debt investment, so they would either route it through a FD in a bank, or they would come for a venture debt piece, which can offer them a return between say 10 to 20% is the return that is being offered. Now, when as a investor, when I am wanting to go into this private credit space, and private credit space is a very very transparent mechanism. So as a fund manager, if I am kind of investing in say 20 companies, as an investor who is an LP for me, he would know where I'm investing and what is my strategy, what all I'm looking at when I'm making an investment. So it's a very very transparent way of investing, which is giving a lot of confidence to some of the LPs. So and it's also it's a the fund life can be between say 5 to 6 years. If at all it can be extended by one more year. So you see that that you will get your at least a decent return. As I told you, the returns are between say maybe 10 to 20% return depending on the thesis of the fund, and you will get your money back, vis-a-vis a VC fund where it's kind of open-ended. You stay invested, you be there with the company for like 7 years, 8 years, 10 years, or you don't know where you are going to see the light. But in debt fund, it's a kind of closed-ended fund where most of them you get returns. I mean, I'm saying good returns plus your principal is back. Returns are between in this range, and you also get the transparent way of looking at companies, the underlying companies that you know. So these are advantages of private credit. So that is why you will find private credit, as per some estimate, it is 70 to 80,000 crore business. You will see that private credit space will grow big, because as we were talking, the kind of flexibility that we offer to the customer, as well as the transparency that we bring for the LP. So it's a win-win situation at both sides. I hope I answered.
Thanks
Uh,
for that, Chetan. I think we'll
yeah.
have to do another episode just for comparisons of venture debt and venture equity, because the follow-up argument can sort of really happen. But then in venture capital, you have home runs where you put in X and take out 300X, which can actually make up for 3 times of the fund also.
So
But
yes,
that's a
my
different
point.
topic.
Yeah, exactly. So my point is, say out of 10 investments in venture capital, probably 8 might go bust, 2 might be a super duper sixer. But in a debt, you will get at least say 8 to 9 case properly. Maybe one case you might have an issue, but most of the fund managers are aware of the situation, and they'll just take that money out. So net, it's like in fixed income, instead of you earning say 6 to 8% through an FD or a mutual fund, here we are offering between say 10 to 12% at least, or maybe 18% at best. So out of your overall portfolio, a little bit can come for a fixed income, and of that fixed income, a little bit can come for a private credit space.
Thanks for that. I come to you now, Sonal. Give us a sense of some of the innovative structures that you are seeing coming into the way, in terms of either the contracts or the conversation, or just some of the trends that you are picking up as this asset class is kind of evolving.
Yeah, so I think it's more of a trend that I'm seeing. Like I've said earlier, the documentation, are pretty much, it's nothing new that we've seen the documentation, to be honest. It's mezzanine financing. There are certain innovative options or innovative concepts that are put in, like your reward financing, etc. But I think there are a couple of trends that I've seen, and that's more are surrounding the private wealth, family offices. I think that's one domestic pool. So, like if you see 5 to 6 years back, foreign investors played a major role in private credit. Obviously, and that helped a lot of founders. It cleared a lot of their NP resolutions, issues were resolved. Obviously, the high yield, high returns, and the regulatory environment was like a spoiler to that game. What we are seeing is funds are now pulling in the domestic fund pool. So your high net individuals, your ultra high net individuals, your family offices, who, like Chetan explained, are now even they are getting a bit more savvy and educated about it. And they're looking for a more structured, a weighted risk evaluated return kind of systems in their investments. We are also looking at a creation, and it is anticipated there's going to be a high volume of HNIs in India. And that's going to be a great pool for private credit and venture debt funds to take from. So I think what is emerging right now is the way these investments can be structured. So, for example, venture debt, like Chetan kind of gave a comparison of how venture equity looks at deals. Venture debt can also prove, or private credit can also prove to be a great source of investments for conservative investors who are not riding the high risk, high return philosophy of venture equity. So there, there are a lot of HNIs who are not too keen, or rather are keen to explore the early stage ecosystems. But because of the whole equity game where they have this larger pool and they always account for two of their portfolios to be those unicorns or soonicorns as they call it, and the rest of it to go like to play average. Venture capital debt or venture private credit can be also a very great tool for those conservative investors or family offices who want to test the waters but also want to play safe.
So testing the water phenomenon.
Yes. And I think that's one trend that I'm seeing, because we have seen, like, for example, Alpha Alternative is like a great example. They've got their new fund which is purely pooled around family offices and HNIs and ultra HNIs. So we are seeing that trend where even the investors are looking at this asset of funding source as a great way of pooling resources. And I think this is where I think there's going to be a lot of traction. There could be a lot of trends rising from this asset class. And to answer your question, whether this is a new asset class, yes, look at the numbers. It's a $1 trillion asset globally. In India, we have about a commitment of around 500,000 rupees, out of which 50% has already been deployed. So clearly the number speaks for itself. It's something that everyone's looking forward to. I would still say it's still in the nascent stage, purely because of the education and the awareness factor of this. But that's soon going to change, because people, as we speak, I know that funds are out there, looking at new ways of reaching out to companies for financing, etc. So I think this space, I think, is going to see a lot of trend and traction.
Yeah, I do feel that when the mainstreaming of private credit happens, be it in the venture space or the larger companies, it will only be then it will realize its full potential. We are still scratching the surface right now. If we should really have about 100 funds doing this as of now, as we speak. I'm sure maybe Anicut will sort of take the lead maybe in the next 10 years and sort of emerge as the winner there. I think we have had a lot of conversation, and it's been a very interesting and meaningful conversation, decoding quite a few layers of the entire space. But a conversation like this, of course, cannot end talking about the challenges. And now we have about sort of 8 to 10 odd minutes left. So let's spend some time talking about the challenges also as this asset class evolves, be it in terms of the returns, be it in terms of understanding of it, or be it in terms of just trying to push the envelope further. Yes, Chetan.
Okay, I will pick up this. I will just talk about 2, 3 major issues that we face on day-to-day basis. Firstly, what is happening is, as Sonal mentioned, there are too many players who are entering into this space. Good space to be, but what is happening in the market is too much of liquidity from the private credit space is available. Now, the moment you have too much of liquidity, and the founders have their own expectation, as I mentioned in the early part of the discussion, there are a lot of mispricing is happening in our business, which means that the RAROC, the risk adjusted return on capital, is going down. People are not able to view price that risk properly. That is becoming a bigger issue. And from our side, if we feel that we should offer a 18% return, for an example, a competitor might look at it as a 14-15% return. So that is one thing that we are seeing in our scheme of things, which can be detrimental for the overall fund, because if one or two fund houses don't give certain returns as envisaged, then people might question this model itself. Now, secondly, just on our investment thesis itself, the challenge, as I mentioned, a lot of work has to be put across from fund houses like us in terms of educating some of these people, the founders, in terms of what it is. I mean, it's not a substitute for equity; it's a debt. You have to repay this debt. We can be flexible, but you have to repay this. For that, you have to have a cash flows. For that, you have to either generate profit, or you need to have a capability to raise further capital. So that education is much important. Now, the third bit, which is becoming a bigger challenge for us, is just to connect the dots, is in debt fund. What is happening is, because of the quick requirement, the promoter might take my money and stay put with me for an year or 1.5, for a tenor of 3 years, but he's always looking at options to refinance me. So, which means in a private equity space, if I take 10, 12, 15 positions, I stay put for like 5 years, 6 years. But in my private debt space, I'm always on the business, because my churning is keep on happening, which means I have to look at new opportunities, and I have to really, time some of these executions properly, so that my investors get a fantastic return. uh, and yeah, major final point to this is, we are a fund house, we are not a bank. Okay, so cash flows of the company does not get routed through me. So I don't know what is happening in that company. I will be a slightly reactionary mode rather than quick response mode. If there is some fraud is happening, the company promoter is taking money away from that company, I may not be really aware quickly. I may be aware, once we dive deeper, which can be a 15-day hence or 20-day hence, or maybe at times even we also read it from the newspapers. At times I have seen fund houses also read it from the news. So, is this happened in my portfolio? So, these are like huge challenges that we face in our business.
Definitely. When you have 100 portfolio companies to manage, you definitely can't keep a tab on each of them and have a sort of a micro view on what on the operations of the company really happening. Sonal, I come to you. I think sort of concluding remarks really on the challenges as you see the space evolving.
Yeah, so I think most of the challenges, I think Chetan has absolutely rightly put forward. I think two of them that I would really like to touch upon. One is obviously from an analyst point of view, like Chetan said, his very first point, that sometimes when balance sheets are presented, when numbers are presented, they are fluffed, if, for lack of a better word. And that is something which needs to be seen through. We all love to put a great face forward. We would all love to have the best balance sheets, which is very appealing to the investors. But I think that's the challenge from an investor perspective, to see through it. So that once the debt is gone in, the IR, so they're aware of what the debt that they're giving in, the company has the wherewithal to refinance or service the loan. The last point that Chetan put in is the discovery of defaults. And he's very rightly put it. We've seen cases where, after the deal's done and the announcement is made, that's when the lenders have woken up to the fact that, oh, this has happened, and how do we then deal with? It's more easier in a listed entity where, there are certain disclosures to be made. But when it comes to startups and privately held companies and, smaller, closely held companies, it takes time to kind of discover certain deviations. So I think that's where maybe in the documentation, obviously, there is no, the way I like to see it, there's no document or paper can cover fraud. But the point is that there could be certain checks and balances, like Chetan said, that, the lender may not be as quick to call a default. Maybe he can put in like a cure period, a longer time to discover what it is, actually how it affects it. Obviously, this doesn't take away the ability of the lender to call a default and then trigger all the wheels into motion to recover and ask for a prepayment. But I think it also kind of it has to be a bit more savvy from a documentation perspective. And obviously, as much as we would love our promoters to be educated and our founders to be educated, I think the bottom line, Shrija, is that this is a debt, like Chetan said. It will be treated as a debt. So there will be the same checks and balances. There will be still the same pluses and negatives that comes with the debt. And that is something that one needs to be aware of. Just because you add the word bench or debt doesn't make it any different animal. It's still a debt. Obviously, it's a bit more flexible. It's a bit more viable. It's a bit more friendlier. I mean, it's a lot more friendlier to a founder at the right level and at the right stage.
Cut from the same cloth, right? One needs to
exactly.
Cut from the same cloth. And on the governance issues, one has to realize that governance issues are happening across the board, debt or equity.
Absolutely.
And I'm reminded of a conversation with a fairly big investor. She's someone managing multi-billion-dollar asset management, and she told this to me, that Shrija, no matter how involved you are on the board of the company, you can't battle with somebody's conscience. If somebody has a conscience of cheating you, he or she will. And she was talking about this in context of a large sort of unraveling that happened. So I think these are skeletons in everybody's portfolio. All of us have that. I think we had a very insightful sort of conversation, and we can just go on and on to talk about the advantages or disadvantages or the challenges and how sort of the asset class will evolve. But sort of the last comment, and I think for me, was stuck in my mind, Chetan, you made a point about India's story, something to the effect that a lot of people will make wealth. I mean, why do you say that? I mean, what is this India story unraveling to you? Why is the India story so appealing? Is it really the once in a lifetime or a century opportunity, the narrative being built? Is it self-serving to VCs and investors like you? Or there is really some reality to this, that there'll be insane amount of wealth creation that will happen?
Okay, from my perspective, yes, next 25 years, maybe 30 years, it's India's India story. Globally, whatever we are seeing, the war, as well as the crude price increase, whatever we are seeing, and accordingly, what is also happening is U.S. debt market has gone to the ceiling with the 33 trillion dollars. So a lot of things are happening at a global macro level. In all the scenario, one sweet spot across the global is India. Just tell me one economy which is growing above 6% consistently is the country India. Now in India, the what is driving us is because of the population. Now population of 140 crore consuming things is a huge number across all the across globally. And apart from Indian consumption, also we are now bringing out a fantastic, make in India concept that we have put effort. I would say we have put effort for the last 5 6 years. Finally, we are seeing lot of light in this make in India concept. Though we we are either number one or number two or number three across various categories in terms of industry. You call pharma, you call automotive, you call electronics. We are entering in a big way. Whatever you are seeing in the headlines in terms of semiconductor, electronic manufacturing that is being happening, it is all coming to the country. I could see it when I talk to my customers. They say that they are putting a lot of capex. So eventually, what I'm trying to make here is, as a fund manager sitting in US, when you look at globally, which is the right space for me to invest, they find that India is the right space. I'll also add to that, in terms of the formalization of the economy that has happened in the last say 3 5 years. That effort government has put in, be it your IBC 2016, be it your GST updates, be it your income tax guidelines, land reforms. And also to add to this, each state government is competing with each other to ensuring that investments are coming in. Some of the investor summit that is happening, we touch base with most of the investor summit. Huge request across global companies wanting to make investment in India. And when somebody is investing, they have at least 25 30 year horizon to stay put in the country. So to just summarize, India is the right sweet spot where investments will come in. There is China one policy is happening where companies wants to, move across their manufacturing setup from China to other parts. It can be Vietnam, Philippines, India. They are looking at options. Uh, uh, Globally, it's a consumption driven economy. India is 140 crore population, superb marketplace for many companies. And finally, a lot of support from the local government, state government in terms of providing them a right kind of ecosystem for them to invest, stay put, give jobs, which will lead to a lot of wealth being created across.
Okay, thanks for that, Chetan. Before we wrap up now, one sentence from you, Sonal, your most significant takeaway from this conversation today, and the same question for you then, Chetan, and then we'll wrap up.
So I think one thing that I always maintain that these are exciting times for India. There's a lot of interest happening from globally. Where countries are now getting up and taking note of India. The government is taking very positive steps. State governments are actually creating from a regulatory space, making it a very investor-friendly environment, creating single window clearances, opportunities for foreign investors. Like Chetan mentioned, in EV, automotive, we have seen states like Karnataka making it very easy for foreign players to come in and set up their manufacturing units and facilities. So my takeaway from this whole situation, and in light of our discussion, is that exciting times to look forward to. I'm looking forward to the founders being more educated and more informative about the various avenues of funding that are going to come in. And I really look forward to this whole Make in India movement that has created such great traction. So that's my takeaway. Exciting times, as I would say.
And Chetan, one significant takeaway from our Zoom conversation today, what would that be? Some insightful takeaway.
Insightful takeaway would be, I mean, knowing about both you people, I think it was interesting discussion that we had on this. Uh, Also, I think in terms of structuring, which Sonal had mentioned, very, very interesting structures that are coming up on the table, which is very challenging for us as a fund manager because it's a quickly growing place and with a limited ecosystem. We should be aware of some of these things. So from my takeaway, I have to be aware of some of these structures that is happening across, which can help in terms of winning more deals for me. So that's kind of takeaway for me.
To spend some more time with Sonal there.
Yeah,
anytime, Chetan, call away.
Yeah,
we have to do more of these conversations then. Until the time we'll see you next. Goodbye and good luck. But we really had a very meaningful conversation. And I'm hoping, especially for startup founders watching this and the fellow investor fraternity, that invest wisely, but also make informed decisions, keeping in mind that the other person on the table knows about the risks and rewards completely. On that note, here's a quick wrap up, and we'll see you next. Bye-bye. Thank you.
Thank you.
Thank you, Chetan.
Thank you. Take care.